Welcome to Problem 14-2B, Bond Discount Entries for Bonds Payable Transactions. On July 1, 2016, Livingston Corporation, a wholesaler of manufacturing equipment, issued $46 million of 20-year 10% bonds at a market-effective interest rate of 11%, receiving cash of $42,309,236. Interest on the bonds is payable semi-annually on December 31st and June 30th. The fiscal year of the company is the calendar year. Notice that when we see $46 million, 20-year, 10%, that this 10% is the contract rate and that the market rate is 11%. The instructions: Number 1, journalize the entry to record the amount of cash proceeds from the issuance of the bonds on July 1, 2016. To journalize this, we are also issuing means that we are selling the bonds, which means we would be receiving cash. It always helps to skip a line so that when you come back to determine whether it was a premium or a discount, you can determine whether you should debit or credit the actual entry for that. We always credit bonds payable when we issue it for the amount of the face amount of the bond, and the amount is $46 million. The amount of cash that it says that we received in the problem is $42,309,236. Looking at the difference between the cash and the bonds payable, we see that we received less cash than the face of the bonds, which would mean that we issued those bonds at a discount. And so we need to debit discount on bonds payable. And the amount here would be the difference between the $46 million and the $42,309,236, which would give us a discount of $3,690,764. And that would be the entry for the issuance of the bond. Instruction number 2, journalize the entries to record the following. A, the first semi-annual interest payment on December 31st, 2016, and the amortization of the bond discount using the straight line method, and it tells us to round to the nearest dollar. B says the interest payment on June 30th, 2017, and the amortization of the bond discount using the straight line method, round to the nearest dollar. So in 2016, December 31st, the first interest payment, we would debit an account, of course, called interest expense, skip a line, and credit cash, and the amount of cash that we would credit here would be the face of the bonds times the contract rate divided by 2, because this is a semi-annual payment. This would mean a cash expenditure of $2,300,000 every time we make a semi-annual interest payment. That would be $46 million times the contract rate, which was 10%, divided by 2. We also have to amortize out the discount on the bonds payable each time that we make a payment. This is a semi-annual bond, which means 2 periods per year, and if it is over a 20-year period, that would mean that there are going to be 40 semi-annual interest payments. To find the amount that we're going to amortize out of the discount, we would take the $3,690,764 and divide it by 40, and then round to the nearest dollar, which gives us $92,269. If we are amortizing out a discount, since it was originally set up as a debit entry, to amortize it out means to take it to zero, so we would be crediting discount on bonds payable, and the amount that we would be amortizing out is the $92,269. To determine the interest expense, we would take the amount of cash that we were paying in this interest payment and add it to the $92,269, which would give us an interest expense for this payment of $2,392,269. The B part of 2 says to record the June payment in 2017. If it is straight line, the actual entry should look exactly the same. Otherwise, a debit to interest expense, a credit to discount on bonds payable, a credit to cash. The cash credit is $2,300,000, amortizing out another $92,269 out of the discount, and recording an interest expense of $2,392,269. Part 3 says determine the total interest expense for 2016. Well, the total interest expense in 2016, we only had the one entry, or the one interest expense that we paid, for $2,392,269. So that should be our answer. Part 4, will the bond proceeds always be less than the face amount of the bonds when the contract rate is less than the market rate of interest? Your answer to this would be yes. 5. Appendix 1. Compute the price of $42,309,236 received for the bonds by using the present value tables in Appendix A at the end of the text. It says to round to the nearest dollar. To find the present value of the bond, we would first start with the face amount of the bond, which was $46 million. We should also go ahead and put the semi-annual cash or interest payments that were made during each interest payment, which would be the $2.3 million that we recorded as the cash being paid out. Since this is a semi-annual bond, to find the present value factor, to find the value of the face, which you would use present value factor of 1, you would go back to Appendix A in your textbook. You should find the interest column that is 1/2 of whatever the effective rate is, otherwise the market rate. And in this case, the effective rate or market rate was 11%. Half of that would be 5.5%. So looking at 5.5% column in the present value of 1 column in Appendix A, go down to 40 periods, and the factor that you would find is 0.11746. To find the present value of the face of the bond, we would multiply the 46 million by the present value factor. Rounding to the nearest dollar, it would give us $5,403,160. To find the present value of the interest payments or cash payments, you would use the present value of an annuity table in your appendix. You would still use the 5.5% column, go down 40 periods, and that present value factor would be 16.04612. To find the present value of the cash payments, you would multiply the 2.3 million times the present value of the annuity factor. Rounding to the nearest dollar, the present value of those payments would be $36,906,076. To find the issue price of the bond, you would add the present value of the face to the present value of the interest payments, giving you $42,309,236. Otherwise, you should come up with the amount plus or minus a couple of dollars of what the textbook had as the issue price of the bond. And that would be the end of 14.2b.